Welcome back. I'm Old Money Ken, and here we ignore the noise to focus on what truly lasts. If your portfolio has 0% gold, that's not a preference. That's walking into a Category 5 hurricane with no roof over your head. People tell me gold is boring. They're right. Gold is incredibly boring until it isn't. Gold is like that quiet neighbor who never says hello. Then one day, you see him boarding up his windows. In that moment, you're forced to ask yourself, wait, what does he know that I don't? In early 2026, gold broke out to new highs, moving above $5,100 an ounce. Bank of America is pointing to the start of the fifth major U.S. dollar bear market. Even titans like Yardeni are looking away from U.S. dominance for the first time in 15 years. When the dollar retreats, gold rises to meet the moment. For those of you who are new here, I'm Old Money Ken. I used to manage real capital, millions of dollars, right here in Los Angeles. Now, let's be honest. Gold recently hit a peak and then pulled back. The tourists are already saying it's over. They're wrong. A pullback doesn't erase a 9 times move since 2006. It just means the elevator paused between floors. My rule is simple. I don't go all in like a gambler. I add on purpose, on a schedule, by rule. The real problem is that we only look at the world in dollars. Our sense of value has gone numb. So let's change the lens. Instead of asking, what does this cost in dollars, ask, how many ounces of gold does it take to buy this? When you do that, you realize your money has been gaslighting you for decades. Let's look at a few examples. The MacBook. In 2006, it was about $599, around 1.1 ounces of gold. Today, it's still around $599, but only about 0.1 ounces of gold. On the surface, the price looks the same. In terms of gold, it got dramatically cheaper. Gasoline. On paper, it went from about $2.33 a gallon to $3.20 a gallon. Again, in gold, it got cheaper. Your rent. Maybe it went from $728 a month to $1,500. In paper terms, it doubled. In gold terms, it dropped from around 1.3 to 0.3. The dollar surrendered. Gold shows you what actually happened. A new car. Say $19,000 then and $28,000 now. In dollars, that's inflation. In gold terms, it went from about 35 ounces down to 5.7. When you price things in gold, you don't just see prices, you see the truth about your currency. Now, I want to be very clear. What I'm about to share is my personal structure, built from my own journey. It is not a commandment. It's simply my truth. Here's how my liquid assets are balanced. Stocks at 50%, this is your growth engine. Cash at 35%, this is your defense and dry powder. Bitcoin at 7%, your digital exit ramp if the system changes. And gold at 8%, your anchor. Inside that 8% gold slice, I divide it further. Roughly 10% of that gold allocation is in physical form. But here's the key. I buy small units. Physical gold is my emergency fund, my ultimate insurance. In a true crisis, you don't want a 1-kilogram bar you can't divide. You want smaller, liquid pieces that can actually be used to buy what you need. The remaining 90% of my gold sits in ETFs, so I can move tactically when markets shift. So, how do I actually buy? I use what I call a hybrid system. First, steady dollar cost averaging. Every week or every month on the same day, I buy a fixed amount. If gold is high, I'm simply paying the premium for the insurance I want to hold. If gold pulls back, I'm automatically buying more stored time at a discount. In the long run, rhythm beats genius. Second, the pullback ladder. You set your triggers before your emotions show up. From a recent high, if gold drops 3%, that's your first ladder buy. If it falls 6%, you execute the second. If it reaches 10%, you add a third time. You're not trying to perfectly time the market. You're following a disciplined rule that adds to your insurance precisely when most people are panicking. But owning assets is only half the story. The real secret to staying wealthy is rebalancing. If gold surges and suddenly becomes 15% of your portfolio, you don't just celebrate. You sell the excess and move those profits back into stocks or cash. You're shaving gains from what got expensive. Then, when the stock market crashes and fear takes over, that is when you use your anchor. You sell high and you buy low, automatically because your rules tell you to. That is how a portfolio breathes. Is 8% gold too much? The data doesn't say so. What I can tell you is this: 0% gold means you are effectively all in on a ruler that is already cracking. Don't do that to yourself. In our next session, I'm going to open up about the most controversial slice of my portfolio, Bitcoin. We'll talk about how I think about holding it like an insurance policy over the next 20 years. You won't want to miss that conversation. Don't chase wealth. Let wealth chase you. I'm Old Money Ken. Keep your eyes and your heart open to the truth.